In today's video, I want to share with you how this dividend stock could be paying your mortgage. This dividend growth stock has a current yield of 8.6%. It has crushed the S&P 500 over the last 5 years and they have a 5-year dividend growth rate of 17%. I'm talking about Arbor Realty. Let's see how they make money, if their dividends are sustainable and if Arbor is on sale. Before we take a look at how Arbor Realty could be paying your mortgage, we have to analyze their business first. Otherwise, you could be losing your investment just as fast as you hit that buy button in the first place. Arbor Realty was established in 1983 and began as a leading single-family lender. In 2008, they got absolutely crushed in the Great Recession with a 96% decline in share price and a massive dividend cut. But they got back up and began making massive profits and a resulting massive dividend growth that followed. I'm about to share with you why I think it is unlikely that scenario will repeat itself. But before I do, first a little bit more about Arbor Realty. Today they are one of the US leading multifamily lenders and are partnered up with the biggest government-backed agencies like Freddie Mac and Fannie Mae. Arbor Realty is a mortgage REIT or M-REIT. Typically I like to stay away from mortgage REITs due to the risk involved in them. But Arbor Realty is not your typical mortgage REIT. More on that in a bit. Unlike normal REITs, mortgage REITs don't generate revenue from rents received, as they don't own the actual buildings, but rather the financing vehicles behind such assets. Typically, mortgage REITs generate revenue from what is called the interest spread, the difference between the cost of funding the loans versus the interest they receive. And in that, mortgage REITs are very susceptible for changes in interest rates. Back to Arbor Realty. Arbor is an internally managed REIT and the current CEO, Ivan Kaufman, also founded Arbor in 1983. A founder-led company is always a plus. The management team also has a strong incentive to provide good shareholder returns, since they hold 14% of ownership. But the biggest difference between Arbor and some of their mortgage REIT peers is their diverse income streams. The CEO also mentions this several times in the interviews I have watched. Like I said, their focus is on multifamily homes, but they offer different product lines. Balance sheet loan origination, GSE agency and private label loan origination, servicing and single-family rentals. Most mortgage REITs only offer one of these income streams, leaving them vulnerable. But there's something that is worrying me with mortgage REITs, and it is their susceptibility for changes in interest rates. And if there is something we do not want when those dividends are going to cover our mortgage payments, it is a dividend cut because of volatility in earnings. With the Fed announcing that they will start to raise interest rates at a quicker pace, let's see how this would impact Arbor Realty. 2017 to 2019 was also a period of rising interest rates. Let's see how Arbor did there. Looking at the revenue here and net income here, Arbor Realty didn't seem to have suffered. On the contrary, actually, they thrived, with the profit margin rising from 28% to 37% in 2019. As Arbor is in the practice of selling loans through their agency business, they utilize agency rate lock and forward sale commitments, which are contractual commitments to originate and sell mortgage loans at fixed prices with fixed expiration dates. Right, time to take a look at the dividends to see if it could be paying our mortgage. After a massive dividend cut during the Great Recession in 2008, they have increased their dividends steadily over the last years, with several different hikes in 2020 and 2021, resulting in a current yield of 8.6%. I want you to listen to this interview bit with CEO Ivan Kaufman.
55 cents per diluted common share compared to a net loss of $59.3 million or 54 cents per diluted common share. Why the turnaround? Congrats, by the way.
Listen, it's been an unbelievable run for us here at Arbor Realty Trust. I mean, this is the 10th year in a row that we've raised our dividend with 4 consecutive dividend increases.
What I noticed straight away is the interviewing is complimenting Arbor on its performance, and the very first thing Ivan Kaufman mentions is their recent dividend streak. That tells me a lot as a dividend investor. It tells me the dividend streak is important to them. Sure, Tom, important or not, if they don't make enough money to maintain that dividend, they will have to cut it anyway. True, good point. The Simply Safe dividend score of 50, meaning borderline safe, doesn't give us that much confidence. So let's look further. Their payout ratio is in the low to mid 70% range, which is the lowest payout ratio in the mortgage REIT industry. And remember, REITs are required by law to pay out at least 90% of their taxable income to qualify as a REIT. So the low payout ratio doesn't give us much reason to worry. Then what does? The performance in the Great Recession of 2008, a dividend cut, sales dropping by almost 400% and a negative return of 96%. This is the definition of losing your shirt. This video is sponsored by Freedom24, a European broker that allows you to buy stocks on all the big exchanges, offers a 3% yield on their bank accounts, and allows you to easily get in on IPOs. Get your free stock worth up to $600 by clicking on the link in the description. Back to the scheduled programming. The structured portfolio does look much different now than it did back then. During that crisis, Arbor suffered steep losses across its loans backing hotels and land. Back then, they didn't have the agency business that they acquired in 2016. So that 8.6% sure does look juicy for our mortgage payments, if you can stomach the sometimes steep declines in share price. After we have checked out the rest of Arbor Realty's business, I will show you how Arbor could be paying your mortgage with an initial investment of just $10,000. Keep watching. But the growth of Arbor Realty does not come without consequence. Their long-term debt just keeps increasing year over year. Shares outstanding have gone up significantly as well, and in some cases companies are just growing for the sake of getting bigger. But is that really the case with Arbor Realty? Luckily there are a few ways to check this. One way is by looking at the per share metrics. So in the case of Arbor Realty, the earnings per share. Arbor passes this task with growing earnings per share since 2013 for almost each year with a few exceptions. Now we know that Arbor is not diluting us shareholders without meaning, because they are giving us back more profits per share in return. What about that debt though, Tom? We can check this by looking at the net debt to capital ratio. So basically how dependent they are on funding their operations with debt. Their net debt to capital ratio has steadily increased over the years and is just a bit above the 0.8 ratio that Simply Safe Dividends recommends. But I don't really see a red flag here yet. This is good to keep an eye on though, if you decide to invest. Now that we know Arbor Realty is a profitable and growing business, we also want to know if they can sustain this. And for us dividend investors, if they can keep raising their dividends to pay our mortgage. Although there's never a way to be 100% sure how they will perform in the future. There is a way to make an educated guess if they at least perform as good or preferably better than their peers in the industry. And that is what we're looking for. Companies that are leaders in their industry. In other words, if Arbor Realty has a moat. One way to objectively measure this is by looking at the return on equity. The return they are able to generate for every dollar shareholders invested in them. So let's see if the business model of Arbor is able to generate better returns than other mortgage REITs like NLE Capital, New Residential Corp, and AG&C Management. Based on 2020 numbers, Arbor Realty has the best return on equity. Based on this alone, it looks like Arbor Realty has a good moat in the specific multifamily segment. Another sign is that they are partnered up and mentioned in prime places on the websites of Freddie Mac and Fannie Mae. There's one thing we have to be honest about with Arbor Realty though. They are kind of in a perfect storm right now. Let's listen again to part of an interview with the CEO.
We're just in a great space. We're a multifamily lender. We're very active in the single family rental space. And those segments of the economy are just ripping and roaring. And with fueled by low interest rates and an imbalance of supply and demand and an attractive investment class, we're just in the right space at the right time.
He sums up a few key elements very quickly. Arbor is a lender in the multifamily and very active in the single-family rental space, and those segments of the economy are firing on all cylinders right now. What does Ivan Kaufman, the CEO, have to say about the future? There's a wealth of information in these interviews, so let's listen to another bit.
What nobody realizes, and it's something I say to many people, and they look at me cross-eyed, is that there are more people living in single-family rental homes than multifamily homes. So it's a bigger market, a bigger space. And with institutional capital coming and professional management coming to the space, it's just becoming more and more attractive.
Again, a few interesting points. There are more people living in single-family rentals than they do in multifamily homes. So single-family homes are a bigger market and a bigger space than multifamily. And with institutional capital and professional management coming to the space, it is just becoming more and more attractive. Arbor also mentions their growth opportunities in the most recent quarterly report. The good thing is that because they are so diversified, often other business segments also fuel their agency business. Analysts have a bit of a more negative view though. They expect a slight decline in 2022 and only a 2% growth rate in earnings in 2023. But Arbor has surprised analysts to the upside without exception since 2012. Valuation. Is Arbor on sale by any chance? Fastgraphs predicts only a 3.6% return until the end of 2023. Finbox sees an upside of almost 15% to $21 though. And the current dividend yield indicates that Arbor is right around fair value. Am I enticed to buy into Arbor Realty after this? Absolutely. And now the $1 million question. How much would I need for Arbor to be paying my mortgage each month? Let's take my own mortgage of about $600 per month, so $7,200 per year. Yeah, I know, not really US standards. Right now, I would need a bit more than 4,500 shares or an investment of around 83,000 to cover my mortgage payments year-round with Arbor. That is still quite disappointing, to be honest. But hold on. Arbor Realty does not only have a high current yield, they also grow their dividends each year. If you drop 10k on Arbor today, put those sweet dividend reinvestments to work and add about $420 each month, you would be covering your mortgage in just 6.5 years already. And that is not even the best news. After 10 years you would receive more than triple your mortgage in dividends each year. Looking for more dividend growth companies with a high yield? Then definitely check out the battle between Enbridge and Pembina.